I don't think we're in the midst of a Italy or whatever you want to brand it. And I think the market's probably overreacting. We're going to come to a conclusion where the EU and Italy will come to a compromise. And it probably still won't be sustainable, but the EU will brand it as sustainable, is our view.
And you nailed it, Patrick. And the reason that we're talking about it is a little bit like the reason we talked about Greece so many years ago. And it's no insult to Italy or Greece, but their markets don't matter that much by themselves. The risk of Greece was that it owed a bunch of money to Germany and other countries in Europe, and that there was concerns about breaking up the euro. Is Italy anywhere near the level of concern we were at the beginning of the Greek worries?
It isn't as much. In 2011, all of the European banks owned Italian debt. And it's actually turned into a situation now where Italian banks own Italian debt. The contagion risk is much lower because the banks have much higher capital ratios, much more solvent, and it's not the contagion issues we were worried about in 2011 with Italy, Spain, and Greece, all of those issues. Right now, a much sounder banking system, European-wise, but anything that creates a potential risk to the Eurozone, and Italy's a much bigger economy as a proportion of the Eurozone economy than Greece ever was. But in terms of the banking stability and contagion, I think those issues aren't going to come up the way they did 7 years ago.
Does ultimately all of this, however it ends up ultimately, Patrick, make the U.S. even more attractive to foreign investors?
There's a lot going for the U.S. right now, but I think there's some very big risks in the U.S. right now. And I think it's the Fed and inflation that the market's just underestimating. Even the Fed itself, it's got dot plots much higher than the market. But inflation pressures are growing. Wages are coming in strong. We've got the payrolls number coming out on Friday, which is very important, not just for the jobs created, but if you look at the wage growth. The economy's not necessarily overheating, but it's producing above capacity, and you've got $1 trillion deficit basically fueling that. So I think one thing the market isn't pricing properly is that the Fed's going to meet its dots, and it might even have to beat those dots if inflation and wage growth happens in line with what we've seen over the last 4 years. 4 years ago today, inflation was 0.1% in the U.S., and it's gone up about 0.8% a year. We're at 2.7% headline CPI in the U.S. right now. So the U.S. already has a bit of an inflation problem. And if you've got fiscal stimulus and an economy growing at 5.5% nominal, that becomes a real risk right now.